Good afternoon and welcome to today's webinar, Year-End Tax Strategies and Looking Ahead to 2021. Before we get started, I just wanted to go over a couple quick announcements. For those of you attending this webinar, all phones have been placed on mute throughout this presentation. Should you have any questions throughout, feel free to put them in the questions tab here in your GoToWebinar panel, and we'll try to get to questions as we can. At this point, I'd like to hand it over to Stephanie Casson to begin today's presentation.
Welcome, everyone. My name is Stephanie Casson, and on behalf of Bloom Shapiro, I'd like to thank everyone for joining us today. We have a great discussion planned, including a range of topics, all centered around tax planning. While year-end planning should always be part of the regular consideration, this year in particular, there are many additional factors and uncertainties that make this year less predictable. To name a few, this year we saw a global pandemic and accompanying economic challenges. We saw tax relief bills such as the CARES Act, the Secure Act, and the Paycheck Protection Program. And finally, we saw a lengthy and unpredictable election season. Unfortunately, there's no one-size-fits-all approach to tax planning. So our objective here today is to identify some of those factors and influences for future tax landscape, and also to discuss some plans for the uncertainty and strategies for future success. As questions arise today, we ask that you submit them in the online question feature, and we'll try to do our best to address those as we go or at the end of our panel today. So without further ado, I'd like to introduce our speakers for today's panel discussion. So first, Tim Berry is a partner in our private client and family office group. He specializes in individual tax and trust and estate planning. Stephen Fuller is a partner in our corporate tax group. He specializes in various industries such as manufacturing, distribution and retail, professional service firms, and food and beverage. And Crystal Germanese is a partner that focuses on income taxation of pass-through entities and their owners, specializing in industries such as retail, construction, and real estate. So let's start our conversation today with the topic of estate planning. So Tim, why should people be concerned with estate planning right now?
Well, thank you, Stephanie, and good afternoon, everyone. There's certainly been a lot of talk about the elections and their impact on future tax legislation. But aside from that, there are some very important reasons why people are, or should be, thinking about estate planning right now. First of all, the pandemic itself has brought the idea or the fact of our own mortality to the forefront. And whenever there are uncertainties like there are now, that makes planning much more important and urgent. And we're finding that for many people, the pandemic has been a trigger point to review their estate planning. Secondly, our current estate exemption, which is $11.58 million per person, is currently scheduled to drop to half in 2026. And even if there is no legislation, the current exemption amounts are temporary. And so a lot of taxpayers are thinking of ways that they can perhaps use the higher exemptions before they go away. And remember that some states have their own estate taxes and exemption amounts as well. So for instance, I practice in Massachusetts, and our state exemption up here is only $1 million. So there's plenty of planning to be done in regards to that. Another reason estate planning has become very popular recently is because of the very low, I'd say historically low, interest rate environment that we find ourselves in. Each month, the IRS issues an interest rate, which is called the 75/20 rate. And that rate is used to value gifts or certain gifts that are made. And right now, that rate is at 0.4%, which is basically zero. And when that rate is low, there are certain estate planning techniques that can allow families to provide or transfer wealth to other family members at a potentially reduced gift tax cost.
Could you give us an example of one of those techniques and how they might work?
Sure. One of the more common techniques that's used in this environment is a grantor retained annuity trust, or so-called GRAT, G-R-A-T. And in this type of situation, you have a family member who transfers assets into a trust, and they retain a annuity interest, a fixed annuity interest for a period of years. And at the end of that period of years, whatever is left in the trust will be transferred to the beneficiaries, which are generally the children. And when calculating the amount of the gift, the IRS uses the 75/20 rate, which is that 0.4% rate I just alluded to. And to the extent that the assets inside the trust can appreciate at a rate above 0.4%, then there'll be additional amounts that will pass to the beneficiaries gift tax free. And that is certainly a good thing. A low interest rate environment also is favorable to intrafamily loans because the cost of repaying the loans is certainly less when the interest rate is less. Finally, for all of you out there that own privately owned businesses, if your business has been negatively impacted by COVID-19 and you're looking at a lengthy recovery period, the value of your business is probably depressed. And while that's not a good thing, it does provide the opportunity that you could perhaps make a gift of that, an interest in that business at a lower gift valuation. And at the same time, you can remove any future appreciation from that business interest from your estate. And that's really one of the advantages of making lifetime gifts, is that you can remove future appreciation in the value of those assets from your estate.
Thank you, Tim. Those are some good reasons for people to consider tax planning right now. And now I'm sure everyone's wondering, how does the Biden tax plan impact all of this?
Yeah, so the Biden tax plan, particularly in regards to estate taxes, is a bit nebulous, but we do know a couple things. First of all, his plan would call to accelerate the reduction in the federal estate tax exemption. So, and it would be reduced to at least half of what it is now. So if that happens, that's going to provide some more urgency for taxpayers to take advantage of the higher exemptions before they go away. There's clearly some question as to when that might happen, if it happens at all, but that's one of the things that's on the table. The second thing that's been floated is the possible elimination of the basis step up. And currently what happens when somebody dies, the value of their property or the cost basis of their property is stepped up to fair market value as of date of death. And as a result, any unrealized gains are eliminated. They just go away. If the basis step up itself is eliminated, then that means that heirs and beneficiaries will take a carryover basis and will have to pay capital gains taxes when they sell that property. There's also some speculation that what they mean by elimination of step up is that the unrealized appreciation in assets will be taxed upon somebody's death. So it's possible that if you purchased an asset for say $100 and it's worth $1,000 at your death, that $900 of gain might be taxed when you die. But that's speculation at this point, and we would need more clarification as to exactly what they mean by elimination of the basis step up.
It's clear there's a lot of uncertainty in the political landscape right now that are driving some of our planning considerations. Crystal, how is all this political uncertainty impacting the tax planning you're doing for your clients? Oh, Crystal, I think you're muted.
The system is smart enough to tell me I'm muted too, which was nice. So at the same time, so jumping from the estate and gift planning side to the income tax side, what we're seeing in potentially under Biden's plan would be a rate increase. So for clients that are, or taxpayers that are still making money post this pandemic, they're looking at potentially paying more taxes in the future than they're paying now, especially capital gains rates rising. So that's bringing a lot of planning to the forefront in the last quarter of 2020. People trying to close transactions potentially, in order to take advantage of what's a certain low rate. Um, there's also the clients on the other side that are in need of cash flow right now. So there's a lot to consider there, because the CARES Act that came about earlier this year allowed for a lot of accelerations of deductions. So and carry back of those deductions. So so there could be planning on both sides there.
Has your tax planning changed at all post the election?
I definitely have seen a slowdown. You know, people are a little bit less concerned of an immediate increase in rates starting in 2021, but still we're waiting to see who's going to control the Senate. So right now there's going to be 2 Senate runoff elections in Georgia in January, and if the Republicans take one of those seats, then they will, or hold one of those seats, then it looks like the Democrats will not be able to have majority, or pass even through a reconciliation measure, a completely, one-sided tax plan. So at that point, it seems like we're not looking at immediate rate increases. We're looking at potentially another relief bill only. If the Democrats are able to take both of those seats, then there is some uncertainty again. And will rates increase? They're not, probably. What's the timing of that? We don't know. So it could be not until 2022 at that point. So but we do, because of the uncertainty, and it seems like it's pretty certain that rates will increase at some point, for clients that have a healthy balance sheet, and maybe they're not making a lot of money on their money right now with the historically low interest rates. If you there's a high probability of tax rates increasing in the future, there's definitely people thinking about acceleration of income or transactions to a year where there's certainty in the tax rates.
Are you seeing something similar with your clients, Steve?
Sure, yeah, and I'll focus on C corporations to kind of complement Crystal's guidance. But the easiest way to think about C Corp tax planning is to look how the corporate rate has evolved. So prior to 2018, there was a top rate of 35%, which then changed to 21% through the TCJA. And then there's also potential increases to 28% through Biden's tax plan. So planning really surrounds around these rates. So for example, if you have a net operating loss, you should take advantage of an NOL carryback to utilize the benefit of deductions at the higher rates 5 years ago. Whereas if you are profitable, you may consider accelerating additional taxable income to protect against potential future tax rates.
So what I'm hearing is that potential tax rate increases is really the big driver for planning. So Crystal, what do you see in the Biden tax proposal that would create the biggest impact for pass-through entities and their owners?
So the big item that most people are talking about are capital gain rate increases. So Biden's plan has capital gain rates increasing to an ordinary tax rate rather than the preferential rate they are right now for any taxpayers that make over $1 million. So if you make over $1 million, if you would have had a 20% tax rate in 2020 under a Biden proposal, you would instead have a tax rate at your ordinary rate. Presumably you're in the highest rate bucket, and that could be up to 39.6%. So that's a huge potential increase. So that's where I'm seeing the people the most excited to maybe trigger some income that they wouldn't normally, or if they have a transaction and that's going to happen, ensure that it maybe closes earlier than later. The other thing that's in the Biden tax plan is capping the benefit of the 199A deduction. So the 199A deduction is a 20% deduction on certain types of income, including pass-through income from S corps and partnerships, operating business income. And what that 20% deduction did was it made the rate on that income 29.6%. So instead of, say, a 37% rate for people at the highest rate. So Biden's plan has a cap on that deduction for people that have income earners over $400,000. So that would be a big rate increase for people on their pass-through income as compared to Tax Cuts and Jobs Act.
Mm-hmm. So that's kind of a good segue into the next question that I have. And with so many unknowns and things that are outside of our control, let's talk about what type of control taxpayers do have in the timing of their income. Tim, maybe you can start talking about an individual tax perspective.
Sure, and just following up what Krista was speaking about on the potential increase in capital gains rates, another thing people can do is if they have real estate, rather than entering into like-kind exchanges and deferring those gains to a future year, which may be a higher tax year, they may want to just accelerate and pay the taxes now. But another thing that a lot of taxpayers are considering this year is Roth conversions. Because if they're concerned that rates are going to increase in the future, and maybe their income was lower in 2020 also, they may want to convert to a Roth. They'll pick up income this year, certainly, but then they'll have tax-free earnings on that account going forward. And they can also control their income from the opposite side. They can make additional charitable contributions. The CARES Act allowed allowed people to put more into their charitable contributions to get more of a deduction. The Biden tax plan looks like it might be limiting that to a certain extent, so it might be a good time to consider charitable contributions.
Thank you, Tim. Crystal, do you have anything else to add about other areas where timing might be able to be controlled?
Yeah, so one thing for pass-through entities where you have a bit of control can be a method change. So when you're calculating your business income, you're on certain methodologies, and those are accounting methods, and you need to stick with those accounting methods. However, there are opportunities to change accounting methods. So sometimes where you know it could benefit you on timing, you look to see if you're on certain accounting methods that can change and you have control over those. So some examples could be an accrual to cash method change. You also can have inventory method changes. Depreciation is another big one, where maybe you had a large capital expenditure in a prior year, but you did not take all of the accelerated depreciation that you could have. You can time those method changes, and what a method change generally does is it allows you to, instead of having to go back and amend returns for what you would have picked up in prior years, you can take deductions in the current year or pick up income and spread it out over 4 years generally.
Awesome. And how about you, Steve? Any other thoughts on timing of income?
Yeah, no, Crystal, I think those are great examples. And I think the only caveat to think about is it isn't always that straightforward. So as an example, if you have business interest expense, there are limitations on deductibility based on taxable income with some adjustments, which the CARES Act increased to 50% threshold in 2020. And there's an election you can make to use your 2019 income as your threshold for 2020 calculations, which could be more favorable. So just a few things to think about.
Mm-hmm. So we've already mentioned here today several provisions of the CARES Act, and some of these provisions only provide for temporary relief. Are there other provisions that are no longer available after this year that taxpayers need to consider?
Yeah, so we spoke about NOL carrybacks a little bit before, but that one has a 5-year carryback available through 2020, and then that sunsets and carrybacks are no longer available after that point in time. Carry forwards are available of net operating losses, but that's limited to 80% in those carry forward years of taxable, 80% of taxable income. And Tim, I think there's probably some considerations around RMDs as well.
Yeah, that's right, Steve. Basically, the CARES Act put a moratorium on required minimum distributions from retirement plans for 2020. So anyone who hasn't taken their distribution, they don't have to take it before the end of the year. For those who did take it earlier in the year, there was some relief provisions that allowed them to put that money back into their retirement plan so that it wouldn't be taxable this year. And if you've just recently taken a distribution and you didn't mean to do so, you do have 60 days in which to roll that amount back into your retirement plan, and it won't be taxable for this year.
Great. So before we finish up today, I want to just shift gears briefly to touch on the Paycheck Protection Program. So for purposes of today's panel, we'll be focusing specifically on income tax recognition and timing considerations. I do want to mention that there was a lot of interest in the pre-submitted questions about the PPP forgiveness application process. So we'll be following up directly with those submitted questions in advance for those that are beyond the scope of today's conversation. So Steve, can you get into the uncertainty that exists regarding the tax impact?
Sure, the good stuff everyone's been waiting for. So yeah, so the CARES Act explicitly stated that PPP loan forgiveness would not be income to the taxpayer, which many taxpayers that applied for the loans assumed that meant that the forgiveness would not result in a tax impact. Now, the IRS came out with a notice earlier this year addressing their position, and that expenses paid for using forgiveness income proceeds would be non-deductible. So you'd have an add back for income tax purposes. However, when the period to spend the PPP money and still get forgiveness is extended to year end, questions arose in regard to the timing where someone did not get the forgiveness approved until post year end. So the timing of the deduction or add back. Just hot off the presses yesterday, the IRS confirmed that a taxpayer may not deduct the PPP expenses in the taxable year in which the expenses were paid or incurred. At the end of such taxable year, the taxpayer reasonably expects to receive forgiveness. And again, what does reasonably expect means is still to be determined, but so reasonably expects to receive forgiveness of the covered loan on the basis of expenses that paid or accrued during the cover period, even if the taxpayer has not submitted an application for forgiveness by the end of the taxable year. So that's kind of an important piece here. In conjunction with that, there's a safe harbor provision that states that if the taxpayer follows that position, but then in the following year, meaning 2021, is denied forgiveness or decides not to seek forgiveness, they can then deduct those otherwise non-deductible expenses in 2020 or 2021.
So it sounds like the IRS has issued their guidance then. Does that mean that there's no more uncertainty?
Always uncertainty.
So yeah, there's still uncertainty. So first, there's many people that disagree with the IRS's analysis. So what the IRS gets to their position by saying that the PPP, yes, we agree, the PPP forgiveness is tax exempt. That's straight in the CARES Act. It's not taxable. So how they get to their position is associating the expenses paid with the PPP funds that are used in the forgiveness calculation. They associate those with tax exempt income, and then they say, well, if you've got expenses that were paid with tax exempt income, then those are not deductible. Many people have expressed disagreement with the IRS's analysis and their conclusions that they've come up with that. So there's definitely discussion about reasonable basis positions, using something other than the IRS's position on these expenses. As far as timing goes, we were expecting this to come, that if through the IRS's theory that these expenses are not deductible because they're associated with tax exempt income, then it would lead people to potentially think that it's as the expenses and as your forgiveness is earned and as the expenses are incurred, that would be the timing of when the expenses are disallowed. So I know a lot of people were hopeful that that because their forgiveness app has not been approved, that they can push off the non-deductibility of the expenses to a following year. But the IRS has confirmed, as Stephen said, their opinion and their position on that. But then the biggest thing is, I think people are waiting for a legislative fix, and they're definitely, from what we hear, commentators are saying there's bipartisan support for that. There's been a couple of bills from the House that have for future relief packages that have not gone anywhere yet, and they've both included a legislative fix. And what that means is that they want to pass legislation that the expenses would still be deductible. So that's, I think, what people are hopeful for, and because there's bipartisan support, that could get passed through regardless of who controls the Senate. However, it's still politics, and I don't know if people recall back to when there was the QIP, the Qualified Improvement Property error in the original Tax Cuts and Jobs Act. They had intended to say that QIP is permanent. There's 15-year qualified improvement property eligible for 100% bonus depreciation, but they did not write the legislation correctly. Well, we thought that would be an immediate fix, and that took years, and it took a CARES Act pandemic relief bill to get that fixed. So, while people are hopeful for that legislative fix, I think the AICPA is one that is very hopeful for a legislative fix for PPP deductibility of expenses. It's still politics, so it's still going to be uncertain.
Mhm. So are there strategies then for approaching the PPP as the current guidance stands?
Yeah, so if the current guidance holds up in the PPP, the expenses used for the forgiveness are not deductible, then there are definitely thoughts about carefully choosing the expenses that you are going to use for your forgiveness. So obviously, first and foremost, you want to get full forgiveness, right? So you're not going to jeopardize full forgiveness to pick and choose for different potential tax savings. So say all things on forgiveness level being the same, if it benefits you to forgive certain expenses rather than others, then that is something you may want to look at. So some examples. Payroll is an expense that is the biggest expense that you're going to have on your forgiveness application. Well, say you're a fiscal year and your forgiveness period lapse both years. Well, maybe you're picking and choosing which payroll you want in which weeks that you want on your application. Also, the 199A deduction that I mentioned earlier, that 20% deduction, that is a deduction that is dependent on your wages. So if you are reducing your wages to the point where you might lose out on that deduction, then maybe, and you have other eligible expenses, then maybe you want to use some of those other eligible expenses to the extent you can. Another area is interest expense. So to the extent that you're paying mortgage interest or personal property related interest expense, and you're being limited by the 163J limitation that Steve mentioned earlier, potentially disallowing some of those deductions because they're on your forgiveness application may be a benefit to you, because it reduces your overall interest expense, and then you might not be limited as much. So the other thing, like Stephen mentioned, that you reasonably expect to receive the forgiveness by year end. That is the determination. So if you've otherwise earned the forgiveness, but you just haven't filed the application and it's certain that you're going to receive the forgiveness, or pretty certain you're going to receive the forgiveness, that's one thing. But what if you're someone who's taken out a loan in excess of $2 million? Recently, the SBA had put out a questionnaire, a draft form of a questionnaire, and it aims to gather information for what it appears to be to select people for audit on loans that are over $2 million, or target at least their audit efforts on certain people. So do those people still have the same certainty of forgiveness as others? You know, it's all going to be facts and circumstances based and things that you have to look at. And it's something that we will do here. We had dedicated a team of PPP people, a PPP group, to deal and help people with their application process. And that's one thing that they'll look at, is to see, are there certain strategies that we should be using when we're filing for the forgiveness?
Mhm. So you touched on this a bit briefly, but I just want to back up and see if you can help reiterate for us. We have a question. We've got several about the PPP, but specifically about the timing of applying for forgiveness, whether that be in 2020 or 2021. So you touched on that a little bit, and how there's other factors other than just the actual application and granting of forgiveness. If you could just
Yeah.
go over that one more time, if you don't mind.
Yeah. So bottom line is, based on the IRS's guidance, it might not matter when you apply for the forgiveness and when you get approved for the forgiveness. So you really have to look at your individual facts and circumstances. And if you've fully earned the forgiveness by the expenses that you've paid in 2020, even if you apply for the forgiveness in 2021 and get your forgiveness approved in 2021, if that was just a ministerial task to file the application and get the approval, and you otherwise, the IRS looks at it as that you have otherwise earned that forgiveness, then your expenses in 2020 are still going to be disallowed, and it's not going to matter that you filed the application post year end. But it's definitely something that you want to get guidance on, you want to look at based on your individual facts and circumstances.
Awesome. So with no guarantee of a legislative fix, how challenging is it going to be for taxpayers to file their tax returns?
So you're right. So for businesses where they're still struggling, say, and they do not have the excess cash, and they want to take a position for estimates and extensions, that there may be a legislative fix, and so they don't want to pay taxes on those expenses that are going to be disallowed. It's really up to the choice of that client. So obviously, like, our recommendation would be in that case to extend the return, file the return at the latest date possible. But if you don't fully pay in your taxes by fourth quarter, and then definitely by the due date of your tax return, there will be interest and penalties potentially on if then when you file it is due. So it's really up to each individual person and what their tolerance is and what their cash flow ability is. If you've got the cash flow otherwise, and you are very adverse to paying interest and penalties, then you're going to pay in based on the IRS's current guidance and position, and then apply for refunds when you can for when you actually file your tax return.
Thanks, Crystal. So are there any other considerations related to the PPP that we haven't touched on?
Yeah, so the only other thing I'll mention is if you have GAAP financial statements, and if there is no legislative fix prior to year end, tax provisions will need to be based on the current tax law, meaning you may have an expense add back or an uncertain tax position reserve on the books for what they're deemed to going to have a legislative change for. But again, if that's after 12/31/2020, it won't matter for 2020 financial statements.
Awesome. So I'm trying to take a look through the questions here. It looks like we've touched on a lot of these already as we've gone, a lot of interest in the PPP. So here's another, maybe I'll throw this one to you, Tim. What is the highest gift amount in 2020, and will that change in 2021?
So I think that's referring to the annual exclusion, the amount that you can give to any one person in a tax year and not have it considered a taxable gift. And the amount for 2020 is $15,000, and that amount remains the same for 2021. at $15,000 per person. So that amount is indexed by inflation, but it takes a long time to actually get up to the next $1,000, and it increases in $1,000 increments. So it's $15,000 for both 2020 and 2021.
Awesome. Thank you, Tim.
Sure.
Oh, here's another one directly for you.
Tim's popular.
You've got a fan base now, Tim. Any other options besides a GRAP for estate planning for those couples who have an estate between 5.9 and 11.8 million?
Yeah, there are a lot of different options for somebody that's in that area there. Certainly they would be impacted if the exemption goes down. So they would probably be wanting to use up the higher exemption to the extent that they can. The issue with making gifts to use up the exemption is you clearly have to have some money to live on. You can't give away all your assets. One of the vehicles that's very useful, particularly when there's uncertainty in the tax law, is to use what's called a spousal lifetime access trust, which is a way of making a gift into a trust where a spouse still has access to the income of the trust for living purposes, but at the same time you're using up some of your exemption and removing some of the property from your taxable estate. So it all depends on the facts and circumstances, but there are a large number of techniques that can be used for people that are in that range.
Awesome. Thank you, Tim. So I'm going to throw this one over to Steve and Crystal. So can you talk a little bit about the matching of PPP revenues and expenses?
Well, that's part of what the argument, I think, is, right, is there's a struggle from taxpayers to understand why there would be an add back in 2020 for the expenses if you wouldn't get forgiveness for, let's say, book purposes until 2021. Chris, I don't know if you have anything to add on.
Yeah, so I mean, I think that we've looked at it, and obviously, without any other guidance from the IRS, you know, some of this is speculation, but it does look like to us that if all, like I had mentioned earlier, if all other factors are the same and you're going to get your forgiveness, then why not pick and choose the expenses that are going to benefit you the most? And if the IRS comes back and says, well, that's not how it's going to work, and you have to take a pro rata expense approach to your expenses or something along those lines, you've not done any harm as long as you're still getting the same full forgiveness that you would have. But if you did choose to put interest expense, for example, on your application, and you otherwise have a 163(j) interest expense limitation, and the IRS allows this picking and choosing of expenses that you are saying are forgiven and now non-deductible, then you've benefited yourself. So, so why not? Maybe it's a little bit of extra work on the PPP application side, but a potential tax benefit in the future.
Mm-hmm. So we have a question here about, is there going to be a download of the presentation? So this will be emailed out tomorrow to all participants, and it will also be made available on the website for download.
And on the PPP side, I know the people who sent questions ahead of time, as Stephanie said, we're able to connect you because we have your contact information. For people who are emailing questions, we do have, if you, and Steph will go over this, you can go to our website and contact us for the PPP on the PPP side.
Mm-hmm. Yep, we do have a team of PPP experts, so they can answer your very specific questions on application process and other variables. Let's see, we've got some more questions coming in. So we're seeing some questions about picking and choosing expenses to be deducted, challenged by the IRS.
Yeah, so that I think is based on the comment I just made. So yeah, so the IRS has not said exactly how you would pick and choose which expenses are going to be non-deductible. So based on what we're looking at, like I said, it doesn't hurt to pick the best expenses that you can on your application, but there is no guarantee. The IRS could come out with additional guidance. With PPP, it's been a consistent theme since it first came out that the rules kind of keep changing. So without the IRS giving specific guidance into how you pick and choose those types of expenses, that there could be future challenges to that. So you set yourself up for the best you can, and then see if something further comes out.
Which may also be especially true for fiscal year ends that straddle that period. So we're hoping we get some additional guidance on that as well.
Yeah, but as it stands right now, it doesn't seem like there's any harm to doing that. Someone's asking, there's some specific PPP questions coming in, and we're not, this was geared more to the income tax timing of it and not what's forgivable on the expenses. But I did see one that said rental related parties not allowed. I think we're not the PPP experts, but I do think that I don't think they clarified that. I think that rent could be allowed even to a related party, but again, not the PPP experts here. So on the application side.
Awesome. So I think that probably sums up most of the questions that we've got then. We have gotten a few others, but I think those are PPP specific. And like Crystal mentioned, we're going to keep this related to income tax planning and timing. So unless there's any other questions, I'd like to thank you all for taking the time out of your days to be with us today. We hope this has been helpful to get a better sense of some of the factors and other considerations for your tax planning and opportunities that exist. The tax environment is always changing, this year more than most. Bloom Shapiro will continue to be on the forefront of these changes and communicate any guidance and updates. We'll continue to send out information through our newsletters, and that can be found on the website. So please reach out to Bloom Shapiro or your tax partner with any questions or to discuss the specifics of your unique situation. I'd like to thank everyone again for coming today. And just as a reminder, the recording will be made available on our website and will be sent directly to the emails provided when signing up today. And I think that's everything. So enjoy the rest of your day, everyone, and thank you again.